Hey everyone! Welcome back to the channel. Today, I'm breaking down one of the most important topics for any economics student. One that forms the bedrock of macroeconomic analysis: national income accounting. It's a system that helps us understand the overall health and performance of a country's economy. Now don't worry if those terms sound intimidating. I'm here to make sense of it all. We'll take it step by step, and by the end of this video, you'll have a solid grasp of the core concepts. Let's start with the basics. We need to establish a foundation before we can build upon it. National income accounting is about figuring out the total income earned in a country, essentially measuring the economic activity within its borders. It's like taking a snapshot of the nation's financial well-being, and we do that using three main methods, each offering a unique perspective on the same underlying economic reality. The income method, which focuses on summing up all the income earned by individuals and businesses. The expenditure method, which looks at the total spending on goods and services within the economy. And the value-added method. This method calculates the value added at each stage of production to avoid double counting. I'll walk you through these and a bunch of key terms you'll need to know. Understanding these terms is crucial for interpreting economic data and participating in informed discussions about economic policy. First up, types of goods. This is a fundamental distinction that helps us categorize economic output. Consumption goods, also called final goods, these are the end products of the production process, are things we buy for direct use like shoes or a new phone. They satisfy our immediate wants and needs. Capital goods are a little different. They play a crucial role in future production. They're tools, the equipment that helps businesses operate, machinery, the heavy-duty equipment used in factories and production plants, computers, stuff businesses use to make other goods. These goods are not directly consumed but are used to produce other goods and services. Then we have intermediate goods, which are components in the production of final goods, which are used to make final products. These goods undergo further processing before they are sold to consumers. For example, flour and bread. The flour is not consumed directly but is an essential ingredient, or salt in snacks. Similarly, salt enhances the flavor and preservation of snack foods. Now, investment. This is a key driver of economic growth. If a company buys new equipment, that's gross investment. It represents the total amount of investment before accounting for depreciation. But when we subtract depreciation, the loss in value as things get old, reflecting the wear and tear on capital goods over time, we get net investment. This gives us a clearer picture of the actual increase in the capital stock. So, net investment equals gross investment minus depreciation. It's a simple but important equation to remember. Let's talk about costs and prices. Understanding the different ways of valuing goods and services is essential for accurate national income accounting. Factor cost is what's paid to the people and resources that made a product. This includes wages, rent, interest, and profit. Basic price adds in production taxes and subtracts subsidies. This reflects the cost of production plus any government intervention. Market price, what the consumer actually pays. That includes all taxes and subtracts subsidies. It's the final price that reflects all costs and government policies. Think of it as the sticker price you see in stores, the price you pay at the checkout counter. Moving on to the circular flow of income. This is a simplified model of how money and resources flow through the economy. This is just the constant movement of money and goods, a continuous cycle that keeps the economy running between households and businesses. These are the two main actors in the economy. You earn money, you spend it, and it goes around and around. It's a never-ending cycle of production, income, and expenditure. Now let's get into the big numbers. The key indicators that economists use to track the performance of the economy: national income aggregates. These are summary measures of the overall level of economic activity. GDP at market price, GDP-MP, the most widely used measure of economic output, is the value of all final goods and services made within the country. It represents the total value of everything produced within a nation's borders in a given period. It includes depreciation and taxes. These are important components of the overall market price. When you take away depreciation, accounting for the wear and tear on capital goods, you get net domestic product at market price, NDP-MP. This provides a more accurate picture of the net increase in the value of goods and services. Subtracting net indirect taxes, which are taxes like sales tax minus subsidies, gives you net domestic product at factor cost, NDPFC. The income earned by the factors of production, basically, total income actually received by people. This is a key measure of the income available to households. If you include what residents earn abroad, adding in income from foreign sources, you get gross national product at market price, GNPMP. This measures the total value of goods and services produced by a country's residents, regardless of location. And if you adjust for depreciation and taxes to arrive at a net measure at factor cost, you get net national product at factor cost, NNPFC, a comprehensive measure of national income, which is the same as national income. This is the total income earned by a country's residents from all sources. You'll also hear about nominal and real income. These are two different ways of measuring income, with and without adjusting for inflation. Nominal is at current prices, no inflation adjustment. It reflects the actual dollar value of income at a given time. Real is at constant prices, adjusted for changes in the price level, so it tells you more about real growth. It provides a more accurate picture of changes in purchasing power. Now, how do we calculate national income? Let's delve into the different approaches used to measure national income. The product or value-added method, also known as the production approach, looks at the value a business adds to raw materials. This avoids double counting intermediate goods. The expenditure method focuses on the total spending in the economy, adds up everything spent by consumers, businesses, and the government. This includes consumption, investment, government spending, and net exports. And the income method, which focuses on the income earned by factors of production, totals up wages, rent, interest, profits, and mixed income from self-employed folks. It captures all the income generated in the production process. Finally, remember, it's important to keep in mind the limitations of these measures. GDP is a big deal, but it's not everything. It's just one piece of the puzzle when assessing a country's overall well-being. It doesn't count things like unpaid work or environmental costs. These are important factors that are not captured in traditional economic measures. So, while a higher GDP usually means more stuff is being made, indicating increased economic activity, it doesn't always mean everyone's better off. It doesn't necessarily translate to improved quality of life or social well-being for all citizens. Alright, you made it. Congratulations on reaching the end of this video. That's your crash course on national income accounting. I hope this has provided you with a solid foundation in this important area of economics. If you found this helpful, hit that like button, and let me know what you want to learn next. Your feedback is invaluable in helping me create content that meets your needs. Thanks for watching.